Hello everybody. We're here on the home page for my chapter 14 module. As you can see, and you probably already know this, these pages are all basically linked from the weekly module that you have accessible to you within your Canvas site. In the lecture pages, you'll see that there's a link that takes you out to these modules. Now here again, we're looking at chapter 14, and as you know, these include some learning objectives for the chapter. Now, we have 8 of them in this case for chapter 14. You only see 7 up to this point right there, but I'm only going to be focusing on LO3. So generalizing bonds using the straight line method. And so having said that, let me and you will see that this other page, which is the overview page, has a more expanded, more detailed learning objective listing. And in the case of this video, I'm going to be focusing on, again, on LO3, which is issuing bonds using the 3 cases that you're presented with in the textbook. And there are only 3 of them, obviously. And you're going to be issuing bonds at face value, at a discount, or at a premium. And in terms of the actual journal entries, you'll be doing issues in all 3 cases, interest calculations and journal entries, as well as amortization of the discount or amortization of the premium. Obviously, there's no such thing as amortization for the case of issuing at a face value. Let's move on, and I'm going to now move on directly to the homework. I have to navigate there to show you. I'm going to first show you where it's located, and as you know, also within the same chapter module, there is a page for the homework review. And in that on that page, you can navigate to various answer keys. And in our case, for this video, again, we're doing LO3 again, and it will be, in this case, specifically exercise 23. And so if I move on to the given information for the problem, E14-23 is in the back of the chapter in your textbook. In this problem, Franklin, the company, issued $80,000 of 10-year 8% bonds on the 1st of January 2016. So if I do a little timeline, just to kind of give me a view of what is going on in this problem, if this happens to be here 1/1/16, that is when the bonds are being issued. The first payment of the interest will be on 7/1/16, so it will be right there. The end of the year, 12/31, will be here. And the very next day, on 1/1/17, that's when you have the second payment. So for now, if you look at the required for each of these transactions in the requirements, they only ask you for the very first semi-annual payment. So we're only looking at this point in time. With that in mind, let's do both the issue, then the interest here for the first requirement. Now again, this is a situation where it's at face. That means at face, issuing at face means that the issue at face means that the contract rate, or 8%, is equal to the market rate for similar investments outside in the market. So that's also 8%. With that in mind, that means that the pricing of the $80,000 bond is the same as the actual face. So there's no need to discount or apply a premium, because the market rate is the very same as the contract rate. No need to do anything to the price. So that's what we get when we issue those bonds. So on 1/1/16, and let's make 16 right there. We get cash if we're Franklin for $80,000, and then we credit bonds payable for $80,000 as well. So that's on the issue date. Okay, this issue. Oops, cannot spell. Then 6 months later, once we've actually incurred interest on these bonds and we actually make the payment as well on 7/1 of 16, we're going to recognize interest expense for a certain amount, and then we're going to be also paying it. So we have a payment of cash for that same amount. Now, what is this amount? Well, it is always based on the contract rate. Oops, give me a second. Of 8% in this case times the face, or $80,000. Now, if you multiply this out, it should give you about $6,400 for the whole year, because these interest rates are always expressed on yearly terms. Now, this is only half a year. That means that this will be also only half of this amount, or $3,200. So that's how much we are going to be recognizing as expense and paying on 7/1. In the second case, for requirement number 2, the given is the same. We still have the company issuing $80,000 of 10-year bonds, semi-annual interest payments at 8%. So again, the contract rate is still the same. That never changes. It's 8%. Now, the market rate is going to be different, and I'll tell you why in a second. So the market rate is actually higher. Now, how do we know that's higher? We know it's higher. We don't have the information at the moment, but I know it's higher simply because they're asking to issue at 94. That means that we're actually issuing these bonds at 94% of the face of 80,000, and that is only $75,200. That obviously means that we're getting less for the bonds. So we can actually, on 1/1/16, we get cash of only $75,200, yet we're still going to be crediting the bonds payable account. Let me make a little more space, actually. Let me put it here. I need more space. We're still going to be crediting the bonds payable account for the full face of $80,000. So obviously, the investor only gives us or loans us $75,200, yet we're still going to be owing them, the investor or the investors, the full amount. So what is that difference? Well, the difference obviously is the 6% here. Now, why are we selling these bonds at a discount? Well, here's what's going on. The bonds themselves are going to only give the investor 8%. Now, the market is requiring something higher than that. And so the investor, has different options to go out in the market and invest their money into something that is, that gives them the most return on their investment. They're not going to be investing on an 8% bond when they can get something higher than that. So there's going to be some kind of calculation that Franklin must go through to figure out how much lower that pricing should be to then make the investor effectively get the same as they would get outside in the market. So basically this 94 is simply to adjust for the interest that the investor will be earning. And so there's some mechanics that involve the present value calculation that we're going to be learning in a different chapter, in a different section of this chapter. For now, just assume that that's really correct, that the 6% reduction into the face represents the additional amount of interest that the investor requires to actually buy our bonds. So then that discount is actually a debit balance account. So we're going to put the whole thing into the discount on bonds payable account. And if that's the case, the total would be 4,800. So now we're even. Now, this actually, keep in mind that this does represent an additional amount of interest income to the investor. To us, the issuer, this represents additional interest expense. Now we cannot book the whole thing into interest expense at time of issue, because we haven't really gone through the life of the bond yet. I mean, interest is always a function of time, and since we just issued it, there is no interest expense or interest revenue on either side at the moment. So we just book it and put it into that account at the moment. So between these two right now, you would call this the carrying value at 1/116 of these bonds. And so that's how you read these things. Now, all right, having said that, let's actually see what happens on 7/116 when the first payment comes into play. So we can actually book, as we did before, debit interest expense. We're also going to be paying to the investor our first payment, and so that will be cash. In that case, we already know it's always based on 8% that the contract rate times the face, or $80,000, times half, because it's only half the year. If you do the math, that amount is $3,200, which is the same as in the previous case, requirement 1. Now there's an additional amount of interest that comes from the discount right there. So what is that? So we're going to be actually taking the full $4,800 dividing by 20. Why 20? Well, there are 10 periods and they're semi-annual. That means twice a year. So 10 years times 2, that's 20 periods. So we're going to be amortizing that $4,800 of interest expense throughout the life of the bonds at a rate of 1/20th. So if you do the math, it should be something around $240. So that's how much we're going to be reducing that discount account by. So we can actually credit that discount on bonds payable for $240. Now, between these two then, that one and that one right there, that's how much interest expense in total we have in the period. The first portion of that comes from the actual 8% on the bonds. The $240 is what comes from the amortization of the discount, which is additional interest expense to us, additional interest revenue to the investor. Since we only care about us, we're going to do interest expense in total of $3,440. In requirement 3, same given, but now issuing at 103, that means 103% of face. Multiplying that out will give you a total of $82,400. And so if we book the issuance on 1/116, then we have cash of $82,400, and we have a bond payable booking of only $80,000. So again, we're now in the same or a similar situation as before on the discount scenario. In this case, a premium, because I know that I'm getting more than what I'm liable for. The difference there is a premium. So in this case, the credit to a premium on bond payable account will be $2,400. Now again, this will be the carrying value at 1/116. Now again, why is this difference? Well, this additional 3% tells me that the bonds, which are going to feed to the investor revenue or return on the investment of 8%, is actually too much. In other words, the contract rate of 8% It's actually more than the market rate. And again, I don't know what the market rate is in this scenario because it's not given to us. I just know that it's less. And I know that they go through this present value calculation of all the cash flows from those bonds to figure out that it is 3%, the difference between the 8% contract rate and whatever the market rate happens to be. So that is actually basically a given. Now that we have that, we're going to be, again, booking the first interest payment. I'm still going to have a debit to, interest expense. I'm still going to have a credit to cash because I'm paying cash. We have done the calculation for interest payment already twice. It is $30,200. Again, it's contract rate times face times half. 8% times 80,000 times half will give you the cash payment for the interest in each period. That doesn't change no matter what the scenario happens to be. Now we are going to now reduce our interest expense by a portion of this premium. And the premium there is a total of $2,400. If we divide that by 20, because again there's 20 periods, I know I end up with a amount of $120. I'm going to make a little asterisk just to make sure that we know they're talking about that calculation. And the account is this premium amount. We're going to actually reduce it by a 1/20th for this period. So we're going to actually have a debit to this premium account on bonds payable. And now that we know that, now we know that the overall interest for this period is the payment of 3.2, that's 8%, minus the amount that they gave us extra at the beginning that reduces our interest expense by 120. So total interest expense for us in this period would be $3,080.